Hi, I'm Winston.
I'm Christina.
And we are the Real Estate Templates.
We're going to do a really quick video.
We're going to dissect this deal right here. It's at 1080 Slaters Creek in Goodlettsville, Tennessee. When we finish dissecting it down for you, we're actually going to that site and we're going to do an on-site look at it, see if our diagnostics were right or if we would need to make some changes to that right there. So, the house is $299,000. We're going to use $300,000 as our number. I'm going to let my wife go over the house, tell you if she likes it, don't like it.
So this is our house, 3-bedroom, 1 bath, 1,200 square feet. It's all white, pretty brick. I love it. Not my husband's not a fan. It looks good. We didn't, from the pictures that we saw, it didn't look like there was any real damage. Roof looks good. The
roof looks new.
Yeah, the roof looks new. In the description, it actually said there was new flooring, new roof, pretty much
new air conditioning.
New air conditioning, everything's new. So aesthetically, the house looks really good. Did some virtual staging, which was kind of cool. Flooring looks good. Popcorn ceilings, we're not a big fan, but not that big of a deal. The kitchen's beautiful. They did a good job in the kitchen. We're not super happy with the vents here. We're going to check that out when we go on our tour. It's just it's a cute little house.
So for us, where we are right now, we'll use an algorithm of 1%. We'll look at the purchase price, multiply that times 1%. 300,000 times 1% is $3,000. So our price point right now to be able to break even, not make money, to break even is 1% of the total cost of the house. That puts us in a number where we're not losing money every single month on a deal.
$300,000. We use a down payment of $60,000, 20% down payment, and they use 6.407, I think, is the interest rate, and we use 7.
They're saying it would rent out for $1,814 a month. We agree with that number, so we did use that number on our rentals.
Purchase price is $300,000. We're going to use a 20% down that Zillow used, $60,000.
Another reason we're going to use 20% down is most banks, when you're doing real estate and you're investing on rental properties, they want you to put about 20% down on it. We're getting that everywhere we go. We've had some bigger projects we did, they wanted 40% down.
So our loan amount is going to be $240,000. Our monthly note is going to be $1,814, but we go off yearly numbers. The yearly note's going to be $19,160. So we have our yearly note up here, and then we have our yearly rents of the $1,814 times 12 is $21,768. We always include a vacancy factor.
So vacancy factor, we do 7% on vacancy factor. We figure out once every 14 months there's a possibility that house may be vacant. When it's vacant, we're going to lose a month's worth of rent to do a quick touch up on it to make it look really nice. So we always want to figure it up once every 14 months that it's going to be vacant. We take that $1,500, we put it in a different account, we hold it there. When that house comes vacant, whether it's 14 months from now or 2 years from now, that money's there. It covers the expenses of any rehab that we need to do. It covers the expenses of everything, and we're just in really good shape. So that's what the vacancy factor is. You subtract that from your yearly rents, and this is what we're going to use as a number to work with.
So this is going to be your net rents, $20,245. So for capital improvement, we have not been to the house, but based off the pictures and the description and what we saw, we don't have any major capital improvements, so we didn't put anything for capital improvement.
What's a capital improvement?
New roof, HVAC, anything very expensive, water heater, anything like that's going to be
anything over $1,500, $2,000. We put in a capital expenditure thing. We'll put that in a separate account. We'll say, okay, I got to put a new roof on it in 5 years. I'll divide out the cost of that roof by 60 months, and that's how much money out of the rent each month I need to put into a checking account so that I can pay for that when the time comes so we need to replace it.
And so for maintenance, we're taking $500 a month in maintenance. Even if it's a new house, there might be, or a rehabbed house, there might be little things that might be wrong or need to be fixed. Legal and accounting, that's going to be evictions, that's going to be your CPA, anything that's associated with that. So that's what our yearly expenses there. Taxes, city and county, $2,600. Property management, we're doing it based off of 10%, so we have $1,900. So whether you're managing it yourself or whether you're paying somebody else, you want to consider this cost. Insurance, $1,300 a year. Flood insurance, they didn't have in Zillow. That is in a flood zone over there, so we just want to make sure that you take that into account when you're...
We own houses in that neighborhood, so we know that that neighborhood is in a flood zone. There's a creek right next to it.
So we have $7,900 worth of expenses, and so we're going to take our yearly note, and then we're going to take the $7,900 of expenses off. So this is a negative number in the brackets. Yearly note plus the expenses is $27,060. So Our rents are $20,245, so we're actually negative cash flow $68.15
Not a very sexy deal at the moment, is it?
at the moment.
All right, so the throw-off number is, we know that we're losing $6,000
Over there.
a month, $6,800 or a year in cash flow. Number one, I'm not doing any cash flow negative deals right now with interest rates where they are and our economy like it is. I'm not going to do it. But either way, I want to see what this number. So a throw-off is the total amount of money that this property is going to throw off on a yearly basis. How much money can I expect to get from it? So cash flow is just one piece of that pie. Another piece of that pie is appreciation. So houses appreciate in value year over year over year over year over year. Every now and then it might have a zero appreciation. If you look at your area, do a 50-year search on how much your houses appreciate year over year in your area. Across the country, it's a good average of about 5%, what they have done for the last 50 years. You look at the last 10 years, it's more like 10% or better that a lot of areas in our country have achieved. Our area here in Nashville has achieved that over the last 10 years. You got to find what you're comfortable with. 50 years in a row, 5% works. I'm going to go with 5%, and that's what we're going to stick with. If we get better than that, then great, but we're going to go with 5%. So 5% appreciation on $300,000 is $15,000. So we're going to take that, we're going to add it to that 6,800 negative. Now depreciation. So depreciation is an incentivized plan that the government gives you to invest your money in real estate. You cannot get depreciation off of your personal residence. So they give you 27 and a half years to depreciate the total value of the home, not the land, just the home. And you get to depreciate that off every year. They figure over a 27 and a half year period of time, you will replace every single thing in your house. And that's how it happens. So $250,000 we're going to use as our cost on the house value only, not the land. We're going to put $50,000 on the land. 27 and a half years, that comes to 3.6% a year that you can write off. And on this deal right here, that is $9,000. So every year we get to do $9,000. So you take your W-2 or your income, whatever you make, and from the top of it, you remove the first $9,000 off of it. So if you're in a $50,000 tax bracket, you would move $9,000 off of it, or $50,000. You'd remove $9,000, and now you're going to pay taxes on $41,000 instead of $9,000. So if you were in a 24% tax bracket, $9,000 writing off is going to give you $2,160 that you don't pay in taxes that you would have paid had you not owned that house. That is money you get every single year. You can get it for 27 and a half years, you get that money. So that is income. If you pay taxes, they're going to give you a refund of that money and give that money back to you. So it's going to keep you from paying taxes that you would normally pay. Then we're going to look at principal reduction. So we pull a note and we pay a note every single month. A portion of our note goes to principal reduction. A portion of our note goes to interest. In the beginning years of a note, the note is a whole lot more interest than it is principal. So this one right here on year number one, our principal reduction was $2,437. So if we add up the $2,437, the $2,160, the $15,000, and the negative $6,800, we're going to get $12,782 return on our investment of $60,000. That's going to give us a 21% return as a whole. That's not cash. That's your return as a whole. That is how you develop wealth over becoming rich. That's the difference between being rich and being wealthy. Wealthy, you got a lot of your money in your assets too. It's not just cash in a bank. So I would not do this deal at 21%. I would start looking at a deal probably at about 33%, 34%. If you look at those numbers and we did the 1% rule, that would tell us that we needed to get roughly $3,000 a month instead of what we're getting in rent. And 3,000 times 12 would be how much a year? 36,000 a year. That would put us in a place. We needed 27, right? Mm-hmm. So we needed 27,000. That would put us about almost $800 a month that we would make positive cash flow. So the 1% rule gives us good money in our pocket on this particular deal right here. Every deal should be diagnosed the same way. We did this just to see if we wanted to even go look at a house. Now, because we did the deal, we're going to go look at the house and dissect it down even more. But typically, I would not even go look at that house. If I didn't like this number right here at the end, I didn't like that cash flow number, I would walk away from the deal and I would go analyze another deal. And I would find a deal that I liked, and then I would go look at that piece of property.